Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. All right, Dave, great to be with you today. And thanks everybody for joining for the Top 5 at 5. And again, of course, if you're new to us, this is where we give you some of the best money managers top 5 picks in 20 minutes. So stay tuned for that in terms of getting stock ideas. I think that's what people really want, and also to understand what the fundamentals are. But David, let's start with the top-down perspective, because you can't ignore the macro picture at this point. So what are you watching? And I think particularly it's on the U.S. Treasury front and the spreads that we're seeing and what the bond market might be indicating to us.
Yeah, a lot of stock investors don't pay enough attention to the bond market, and it's usually the bond market that dictates what's usually going to happen in the economy next. So even today, we're starting to see another 10 basis point increase in treasuries. So what we have when you look at the yield curve is a big hump in the 2-year, where those yields have risen faster than the 10 and 30. And that's in pretty much a response to what hedge funds are doing, which is shorting that 2-year treasury right now, on the expectation that rates by the Fed are going to rise another 1.25%. So the way to think about it, whether you're a bond investor or a stock investor, is number one, if the Fed raises rates short term, which is what they have the power to do, and the long-term rates don't rise in tandem, then you're going to have the inverted yield curve. And what we've seen so far as a reaction in the United States is mortgage rates are topping 4% there right now, and demand is starting to fall off. So when you look at commodity prices, the two commodities that are down this year are coffee, but lumber as well. So the home builders are starting to slow down their demand as well. The second thing that has an impact on the stock market is that if the Federal Reserve rates rise another 1.5% between now and the end of the year, that will put corporate bond yields in that 4.5% to 5% range. And suddenly you have competition where after-tax yields on corporate bonds are going to be higher than dividend yields. So people may start to move money out of the stock market into the bond market and go back to that old 60-40 asset mix for stability.
Interesting. David, I want to ask though as well, when going back in terms of taking a look at the 2-year yield, which is moving higher because of the US Fed expectations and rate hikes. And the interesting aspect though is that there is the additional pressure that the hedge funds are shorting the 2 years, expecting the price to go down because there's an inverse relationship between rates going higher and the value of your bond. So that's that part of the equation. But I'm curious, and just that as the alone driver can cause the yield curve to flatten and maybe invert, but it also has to incorporate in terms of the overall picture, what people are really thinking about the 30-year bond, which, if people are hopeful about the future, you would expect that the 30-year yield would be higher than the two-year yield, that the rates would be higher in the future. So what is it, do you think, that the 30-year investors are telling us? Are they just out of the picture, or are they actually saying, we've got a concern about a recession looming?
That would be the talking point right now, is that the concern is that when the rates are finished rising this year, if it quells inflation risks, then the higher rates are going to have an impact on spending, because if people's mortgage rates are going higher, then they have to allocate more money towards debt repayment as well as food and energy. So that's the big concern. But the flip side of that is, don't forget, the Federal Reserve has the power through their quantitative easing to start selling the 30-year and trying to get its yield to go higher to keep that yield curve inverted, or not inverted, but upwardly sloping, which would suggest a better opportunity for the economy and therefore the markets to do well. That's why I think we're probably in a good 6-month time frame of advanced volatility, because we really don't know if inflation is going to be slowed or put under control in the next 6 months just with these rate hikes.
And let's add into the equation as well, for those of us who are, or for those of you who aren't familiar, the Ark ETF and Kathy Wood and how that plays into, I don't know if it's your thinking or just an observation in the market.
It reminds me a lot of year 2000 when the tech bubble burst. And don't forget, the Fed was raising rates at that time as well. So between 2000 and 2003, we went through a difficult recession, which was also hampered by 9/11. So the tech bubble burst. Even if you owned a stock like Microsoft, it hit its peak in December of 99, and it took 17 years to get back to break even. So when I look at Kathy Wood's Ark Investing, you have to understand that, number one, a lot of the stocks that she owns aren't profitable yet. So really she's making a bet on the future. And number two, as a portfolio manager, she has to stay in business until those investments pay off. So it's a matter of not only managing the stock portfolio, but also managing the cash flows in the business. And the fact that she's down 30 to 40% year to date is indicative of the fact that 80% of the stocks on the NASDAQ market are not profitable. So it really is the bubble bursting of all the stay-at-homers that were just buying for the sake of buying, as opposed to thinking of discount rates and with the rise in interest rates, what could the impact be on these companies?
Yeah, David, I've now seen that statistic that 80% of the NASDAQ companies are unprofitable. That's astounding. I mean, I don't know that I would have pegged it at 80%.
Yeah. Well, I just did a survey of 8,000 stocks, including all of the NASDAQ names. And it was just blowing my mind that a lot of them were showing no profits whatsoever, or just stagnant losses. So, and that comes into the play with interest rates rising, that for companies that have no profits and have to keep going back to the market to raise cash, because as a tech company, they're burning through a lot of cash. So the need is there until they have a viable business and can start getting market share and pricing power. Rise in interest rates is not helping the NASDAQ or the small cap. So the Russell 2000 is also suffering this year.
And I know you're also looking at Facebook and Shopify, not from a stock pick perspective today, but what's the analogy here with those two names?
Well, this is the rule of, or the law of diminishing returns, is that companies can rise based on their own merit, but at some point their profitability and the revenue growth is going to start to slow down as they get bigger. So in Facebook's case, it's just a matter of the fact that Apple users can block ads. So Facebook's ad rates have started to fall. In Shopify's case, this is what you get for paying 20 times sales, where the stock was as high as $2,200 a share and has fallen anywhere 60, 70%. I think it's around $900 today. Is that you just can't buy it on the belief that it's going to grow 50% a year forever. At some point, it has to start declining its revenues, and its growth rates start to slow down as they get bigger. Tesla's in the same ballpark right now, because it's hard for them to raise their revenues 100% a year for very long before competition as well as the size of the business starts to eat into their returns.
Right. And so taking all of that, plus the geopolitical tensions, Ukraine-Russia war, the price of oil, concerns surrounding inflation, higher valuations, it's not an easy market at all, you know, and it never is. It never is. But this is, I think, is a little bit more complex.
You bet. And it's a big melting pot of everything going on right now. If you think of the stock markets that are up year to date, they include Brazil, Mexico, and Canada, which are oil related. And then Great Britain, the UK stock market's up about 1% year to date, because the drop in the pound has helped their stocks. And then you think of the currency, where the Canadian dollar US has been pretty flat, but countries that don't have access to oil, like Japan, are getting killed this year. So the Canadian dollar is up about 7% against the Japanese yen. So as we come back home, we look at oil prices rising and the TSX doing well because roughly a third of the index is oil or oil related. And that's what we're getting as well. So investors that don't have oil or ancillary companies to oil are getting their heads handed to them this year.
Mm-hmm. Let's talk a little bit about some of the stocks that you like. And why don't we start with a U.S. company, Chubb Insurance, Chubb Limited. What's the story? What's the fundamentals here in terms of why you like it?
Well, they're one of the largest reinsurance companies in the world. But while most pundits are talking about wanting to own the banks as interest rates rise, I like to look at other sectors of the financial services business to see where opportunities lie. And insurance looks good right now because they've got the tailwinds of rising prices. So anticipating that over the next 5 years, they think their prices will be increasing about 10 to 15% a year.
That much?
Yeah, and that's what they've been doing for the last 2 years.
Okay.
So anytime you have, with global warming and all of these hurricanes, et cetera, sure, a lot of them lay off their risks so they're not 100% exposed to the catastrophe. And that by reinsurance, they might only have 10% exposure, and then they can turn right around and raise rates to offset that. So in Chubb's case, interest rates are good for the insurance industry because you've got all this money sitting on the sidelines that if you're charging more than you're having to pay out, then you get to reinvest the balance, which is why Warren Buffett loves insurance companies, because he gets to reinvest the float. With rates rising, Chubb was unlike other insurers in that most of them would have a 60-40 asset mix in their investment side of the business, but Chubb was 100% fixed income. So with every 1% increase in interest rates is going to add about 1.2 billion of additional investment income for them. So to the bottom line, it's almost like a 50 cents per share increase.
Well, what's the stock reflecting right now?
It's actually up 9% year to date, so it's way outperforming the S&P 500 as a result of the combination of their combined ratio, which is around 89%. So for every dollar that they're underwriting in insurance, only paying out 89 cents. So that $1.10 is growing their investment portfolio, and with rates rising, it's going to be a benefactor for them. Okay,
let's take a look at another one. Teleperformance.
This is essentially, if you think of the old days where people would answer the phones for telemarketers or any kind of service, they're being replaced by robots now. And Teleperformance is at the front of that change. And they're using artificial intelligence to be able to mine the data from all the people that are calling in, offer them other services, customer service, technical support, telemarketing. And it's really been a business that's taken off in the last 5 years. So it's a core holding for us. It's a company that trades out of France, but it's global in nature. Mostly the telecoms and the utilities and the healthcare businesses use them, but they're starting to spread elsewhere through the world. And they just raised the dividend by 38%. So for investors, when you see your dividend jump a large amount, that's usually an indication of what the profit growth expectation is going to be as well. So we're getting both the price appreciation and the dividend increase. So the total return is working out quite well.
Any idea what the yield is right now, approximately?
It's not large. It's only about 1.2%.
Okay.
But again, if it's growing at, say, 15% a year, which I think is its long-term average, then that yield is going to double roughly every 5 years, which is better than the historical norm of companies worldwide, which is about 5 or 6%.
And just to be clear, in terms of the data centers, or not even the data centers, the call centers, is the person on the other side of the phone, is it a person or is it a robot? Because I think so much of our, I get so frustrated. I get it if the business is collecting the data that they then learn from a person, but I don't know if it's a robot, how great that's going to be as an experience, right?
Yeah, and it's at the very early stages of the bot frontier. So it gives them the opportunity to learn and grow from that too. So hopefully your experience in the future will improve.
Yeah, we'll see.
Well, we can't get
Ever
rid
since,
of us. Can't get rid of
ever
humans
since,
forever.
yeah, ever since they started offshoring like 17 years ago, I think everybody's had a poor experience trying to get help, right? My goodness. Okay, next one, CCL Industries, which is based in Canada, an industrial company. Talk to us a little bit about what they actually do.
Well, they're a packaging firm. So consumer packaging, such as potato, the Pringles potato chips and the cardboard tubes, or anything that's covered in plastic is essentially going to be packaged by them. You think about what was shut down during COVID, which is working in the office. So cosmetics revenues fell, which they're a big packager of, or any kind of going to Vegas for a trade show. All of those little stickers on your lapel that says, "Hello, I'm so-and-so." We're not being sold because that was all shut down. So the stock price, I think it hit a high of around 75, trading around in the mid 50s right now as a result of COVID. But here's a company that's one of the leaders in its industry. And if we start to ease away from COVID, from pandemic to endemic, and people start going back to the office and start going to trade shows, then that should start to pick up their earnings, which have pretty much been flat for the last 2 years.
Are you surprised that more people might not be looking at it? I mean, if it's so far off, or 24% off the 52-week high, because it's a reopening play. And, you see the airlines or the cruise lines or Vegas get bid up quite aggressively. It seems that this one doesn't quite kind of get the same attention.
Yeah, and it's just a matter of waiting until people start to see the earnings begin to grow again. The great thing is that they've been able to maintain their operating margins, and as a result have been able to raise the dividend by 14%, which is amazing given that they've been pretty much locked down for the last 2 years.
Yeah.
To grow the revenues and profits. So it's a good idea of how they can manage the business, and number two, manage their capital. So they're generating good free cash flows. So it is one to watch moving forward, and buying at a 24% discount. Certainly a lot better than it was a year and a half ago.
Let's take a look at another one in the United States, Littelfuse Inc. On the NASDAQ as well. What's the story here? It's an auto play of sorts.
Well, they also make fuses across many industries, including cell phones and PCs and utility companies and other things. But if we're moving towards electrification in the future, you cannot turn on anything without having a fuse, otherwise you'll burn up. So this is where it comes into play with the cars. They also make LED lights and sensors, so they're really into the wave of the future as far as lighting and electrification are concerned. What we really like about them, because we've owned them for a very long time, is that they're able to turn their profits into complete free cash flow. And this is what's known as cash conversion. So where you can compare your free cash flow relative to your net profits. If you're at 100%, that gives you an awful lot of financial flexibility. So not only are they in the right space right now, where I'd prefer to own them than a car company, but also they're managing their capital effectively. So they're able to go out into the world, make tuck-in acquisitions, and have it paid off within 2 or 3 years, and then rinse and repeat. So this is why all of the stocks in our portfolios tend to have that cash conversion rate of about 100%, because it gives them that financial flexibility to pay down their debt, raise the dividend at double the rate of other companies out there, buy back shares, increase their percentage of R&D to their revenues so they can stay relevant, and make tuck-in acquisitions. So it's just a matter of the CFO dividend increase, tuck-in acquisitions, pay down debt, or put it towards R&D, and then rinse and repeat. And you end up with long-term returns that tend to be 1 to 1.5 times better than the market itself.
Interesting. Let's take a look at your next one is Steris PLC. The ticker there is STE.
Yep.
In the United States, assuming it trades on the New York Stock Exchange.
Correct.
Okay.
The PLC is there only because they, for tax reasons, went to Ireland to set up shop for the lower tax burden. But they're also making acquisitions around the world. So they're not just a US firm. They've been hurt by shutdown of elective surgeries at hospitals. So again, another COVID issue that once those surgeries start to be performed again, because people can't put off their hip and knee replacements forever. Steris does all the sterilization in the operating rooms, and they also will do the sterilization and provision of endoscopy equipment. Because the elective surgeries, if you want to go in and have something done quickly, for example, have your gallbladder taken out, you're not being cut stem to stern, they just go in with a laparoscopy, or removing in the gallbladder all of the things that build up. They can go in and with the endoscopy and take it out where it's not as invasive.
It's not as invasive, but their property, their main product is the sterilization, Steris.
That's correct. Yep. And we have an aging population in North America and pretty much in the West. So all of those elective surgeries are just creating a backlog right now until the hospitals reopen. And stocks hung in pretty well. I think it's been characteristic of all the medical device companies in the last year or so. You look at Stryker that does hips and knees again. Once everybody starts going back to get them replaced, then you're going to have this backlog of demand that's going to have the revenues and profits rising quickly. So I wouldn't overlook the medical device sector in the US right now as far as investment.
I hear you, and it's been so tough looking at some of the medical device companies because, you know, the fits and starts with the openings and closings because of COVID. You know, I think we thought many times that they would have, you know, started to, you know, perform very well, and it's been a tough go. But they're, you know, they're long-term holds in my opinion. So if you can get them at a discount, you're saying this is pretty interesting. Steris was trading at 28 times, is now about 20 times. That's a huge pullback.
That's right, and that's when I start to get interested. So where most people like to go shopping at stores, this is when I can rub my hands and go, okay, it's time for me to go shopping when I see something trading at a discount to what its fair market value should be.
So to wrap it up here, David, I was going to ask you, when we take a look at all of these names that you've provided us today, Chubb, Littelfuse, CCL Industries, Steris, do you, which ones have you kind of just held for a long time and you'd still be a buyer of versus more of a newer name? Like I'm assuming all of these you would be comfortable to own, to buy today.
Yeah, in some cases, we've owned them anywhere from 10 to 25 years. So we continue to buy them when the opportunities arise, because it all comes down to, if we have 75 names to choose from, creating 30 stock portfolios, I want to pick the ones that are the cheapest at that particular time. But like Warren Buffett, we are investors in companies. We're not stock traders. So our annual turnover is less than 10% a year. And usually it disappears. A stock will disappear more because of a takeover rather than an outright sell. Okay.
But all of these you're comfortable to buy additional shares today?
Definitely.
Okay. All right. David, that was great. Thank you so much for your top-down macro view, which is so important in terms of, you know, what the fixed income market is telling us, because that is, to your point, you know, historically can be right. and then being very tactical in terms of some of the stocks to own today. So thank you.
Oh, my pleasure. It's great to see you again, Catherine.
Thank you.